Good morning. We would like to welcome you to our weekly webinar. Today is September 6th, 2022, and we have just a quick update on the markets and some things that are happening. And anyway, we'll just jump right into it. So one of the things that's happening with the marketplace is that the Fed is pretty much controlling what's happening right now. And we've got a little bit of just a quick chart here. This shows for August what all of the market returns were. And you can see here that if we go from worst to best, this is real estate investment trusts. This is domestic equity, which means all of the markets, large cap, small cap, mid cap, etc. This is just the large cap. Fixed income was also down a negative almost 3%. Small cap actually did better than the most of the rest of the market at only a -2. Global high yield at a -1.5. And the only thing that really produced any type of returns for August was emerging markets equity. And one of the things that we're seeing right now is that most of this is being driven by the central bank. When they met at Jackson Hole, they were looking a little bit for some additional maybe softer signals from the Fed, that they were expectations that maybe the rate hikes weren't going to be as quick, or maybe they wouldn't be as long. But right now, what it looks like is that the Fed strategy, they're calling it hike and hold for next year, which means that it looks like that interest rates will not come down next year. And as they raise rates, they may be a little bit sticky for a little while to try and get inflation down before they start bringing those back down. Here's what's happening right now in the markets. The markets are pricing in about a 70% likelihood that in September we'll have a 75 basis point hike, followed by a 50 basis point hike in November and a 25 basis point hike in December. That'll bring the federal fund rates to about 3.75 to about the 4% range. And expectation for rate cuts in 2023 pretty much were pushed back as we continue a little bit more hawkishness with the 2-year Treasury yields. As you know, as we've visited in the past, Treasury yields have been very, very low. In August, they hit a new high. They hit 3.5% for 2-year Treasuries, and that's the highest level that they've been since 2007. So interest rates very much are going to be the key thing that we're looking at going forward. With everything else that's going on in the market, European energy, China COVID, zero policy, the Russian-Ukraine war, all of those types of things, we just have a lot to kind of wrap our hands around, and there's a lot of movement in the markets. We feel like that there's going to be continued volatility, more than likely through the rest of this year. The only real certainty that we've got right now as far as the markets is that the central banks are pretty laser focused on taming inflation. It looks like that they're also willing to sacrifice some softness in the economy and the labor markets to do so. So again, we need to a little bit prepare for a little bit more volatility as we go forward. We do think the markets will heal. It just may take a little more time than what we had originally anticipated. But long term, we feel like that things will still work. It's one of the things that I've been saying a little bit in the past is this market is kind of like riding a horse with a saddle with sandpaper on it. You probably don't notice it when you first start riding the horse, but after a while it gets really tender. So that's kind of where we're at with the markets right now. Thank you for listening. Thank you for tuning in, and we will catch you next week. Thank you so much.